Welcome to the Deep Dive, your shortcut to understanding earnings calls without wading through pages of transcripts. Today, we're focused squarely on Southside Bancshares, Inc. That's SBSI. We're digging into their Q3 2025 results.
And it was definitely a compost quarter, not your typical organic growth story, this one. It was really all about a massive, intentional move on the balance sheet.
Right. And you saw the immediate reaction, didn't you? Stock closed down 0.5% after the call, even while the rest of the regional bank index was, generally up.
Exactly. That tells you those headline numbers created some serious noise.
Absolutely. So our mission for you today is to unpack these results, decipher what's behind all the adjustments, especially this big restructuring, and we'll look at the path forward, particularly with a leadership change coming up.
A big change.
Okay, let's unpack this. So first off, the thing that probably spooked the market right away was this huge difference in earnings per share.
Yeah, the GAAP versus adjusted.
Right. The standard number, GAAP EPS, just $0.16. Now, net income, only $4.9 million.
Yeah.
That's a massive drop from prior periods.
And that $1.16 JAP compared to, well, the adjusted number was around $0.80. That's startling.
Huge difference.
It really tells the whole story of the quarter, doesn't it? And for anyone wondering, why we even look at the adjusted number, it's because GAAP was just completely skewed by this one-time planned event. Analysts want to see the core performance, strip out that distortion. And that adjusted $0.80. It actually beat the street's $0.72 consensus.
Beat by 11%. So the underlying business was actually doing okay, maybe even better than okay.
Exactly. But the accounting rules meant they had to report that big hit.
So what caused it? What was that roughly $0.64 difference per share?
It boils down to one single item, a massive drag, a $24.4 million realized loss.
Wow.
And it came entirely from strategically restructuring their securities portfolio. And they basically decided to take the pain now to improve profits going forward.
Okay. And despite all that, the top line, net interest income, NII, that looked pretty solid.
Yeah.
$55.7 million, up 2.7% linked quarter.
Right. And the net interest margin, NIM, the core profitability measure, it held up surprisingly well, 2.94%, only down 1 basis point from Q2, which is pretty good given rising funding costs.
Okay, so stability there despite the noise. Here's where it gets really interesting, though. Management spent a lot of time on the call explaining that $24.4 million loss.
You bet they did.
A loss that big.
No, it's a tough pill to swallow publicly. You don't often see a regional bank make such a big, bold move like this. It's like they're shouting, "Trust us," through the numbers.
Well, it was classic balance sheet engineering, really driven by the current rate environment. They weren't just, taking a bath for no reason. They were sacrificing near-term reported earnings for what they see as a very clear long-term payoff.
So what did they actually do?
They sold about $325 million worth of lower-yielding, long-duration assets, mostly municipal bonds and some mortgage-backed securities.
And the key is the yield they were getting on those.
Exactly. The combined yield on a taxable equivalent basis was only 3.28%.
Very low in today's world. That kind of yield is just a drag on overall profitability. So they booked the loss, sold them off, freed up the cash.
And then redeployed it immediately. That's the crucial part.
That's the strategy. Part of the cash went to fund the strong loan growth they had in the quarter. The rest went straight into much higher yielding assets.
Like what?
Specifically, agency MBS. Those are high-quality mortgage securities backed by government agencies with coupons mostly at 5.5% and 6.0%. And also some Texas municipal bonds yielding between 5% and 5.75%.
Okay, so that's a significant jump in yield.
Oh, yeah. At least 200 basis points, maybe more, on that whole $325 million block. And the math, according to them, really supports this aggressive move. Management stated very firmly they expect the payback period for that $24.4 million loss to be less than 4 years.
Less than 4 years.
That's their bet. This sets them up, they believe, for a much higher net interest income trajectory down the road. It gives them more flexibility, better long-term profitability, but, it definitely needs investor patience.
And that muted stock reaction suggests investors are saying, okay, show us the proof.
Exactly. Show us that better NII trajectory before we reward you for it.
All right, so the strategy makes sense. Take the hit, redeploy for higher yield. But none of that matters if the core banking isn't working. How did the fundamentals look this quarter, stripping out the engineering?
Actually, core execution looked very strong. Loan growth was solid, up 3.5% quarter over quarter. Total loans hit $4.77 billion.
And deposits. Always key.
Deposits also grew nicely, up 5.0% to $6.96 billion. That's significant growth.
And management mentioned that came even with some headwinds, right?
It did. A big chunk, almost $289 million, came from broker deposits, but they also had good organic growth in commercial and retail accounts. So they're successfully funding that loan growth, which is critical.
And the loan growth itself, production numbers are big.
Really big. New loan production was around $500 million in Q3. That's way up from $290 million in Q2, almost double.
Wow.
And they pointed out that $81 million of that funded literally on the last day of the quarter.
Setting up Q4 nicely.
Exactly. And crucially, the average rate on those new loans was about 6.7%.
Okay, that's the engine. 6.7%.
That's what drives future NII. And the pipeline looks like it can keep feeding that engine. It's robust, still at $1.8 billion.
Which is much higher than a year ago.
Yeah, up from $1 billion 12 months ago. And their historical success rate, pulling loans through from that pipeline, is still a reliable 25% to 30%.
Okay, strong core performance. But it's running straight into some significant funding headwinds, right?
Yeah.
Management called out two big pressures.
They did. These are going to push up their cost of funds starting now in Q4. First, they issued new debt recently. $150 million in subordinated notes back in August.
Subordinated, so a bit more expensive.
Right. And carrying a hefty 7.000% fixed to float rate, that's pressure point one.
And the second?
The second one might be even bigger. They have existing subordinated notes, about $92 million worth from 2030, that are repricing in mid-November.
Okay, wait, how big is the rate jump on those?
It's massive. The current rate is just 3.875%. That's projected to jump, get this, to an estimated 7.52% floating rate.
Wow. From under 4% to over 7.5%.
That's a huge increase in cost they have to absorb immediately. You need a lot of that 6.7% loan production and the 5.5% securities reinvestment just to offset those kinds of jumps in debt costs.
Okay, so you have those really strong funding headwinds hitting now the full impact of the new 7% debt, this massive reset on the older notes. What's fascinating then is that management still expects NIM, the net interest margin, to be up slightly in the fourth quarter.
Yeah, that caught my ear too. If we connect this to the bigger picture, that optimism really hinges on their confidence that the strategic moves they just made will pay off immediately.
Okay.
They laid out three key drivers that they expect to come online all at once, basically offsetting those rising debt costs.
All right, what are the three? Lay them out for us.
Okay, first, the full quarter benefit from that $325 million securities restructuring we talked about.
Right, they only got part of the benefit in Q3.
Exactly. Q4 gets the full yield lift. Second, average loan balances are expected to rise by about $125 million, even without new growth, just because of that slug of loans that funded right at the end of Q3.
The timing effect.
Right. And third, they're expecting significant savings, around 34 basis points, on over $600 million worth of customer CDs that are maturing and repricing lower.
Okay, so those three positives, they think will outweigh the higher debt costs.
That's the forecast. It's ambitious, but that's their view.
And the board seems to back that confidence. They boosted the share buyback authorization pretty significantly, right?
They did. Added another 1.0 million shares to the authorization on October 16th. That brings the total available to 1.1 million shares. It's definitely a signal of strength and confidence in the outlook.
And management said they'd be opportunistic with it.
Yeah, specifically targeting price dips caused by, this near-term Jap noise we've been talking about.
Makes sense. What about outside the core lending? Any other growth areas?
They sounded pretty upbeat about non-interest income, particularly trust fees. They're expecting double-digit revenue growth there next year. And they're looking at expanding wealth management into bigger metro markets, potentially starting in Fort Worth.
Interesting. And they also mentioned capitalizing on disruption.
Yeah, in Texas. With smaller banks getting bought up by bigger, often out-of-state players, they see an opportunity. They're actively looking to hire talent, maybe pick up some market share that gets shaken loose in those deals.
Okay. And finally, overlaying all of this, the leadership transition.
The biggest variable, perhaps. This was Lee Gibson's last call as CEO. He retires at the end of 2025.
And Keith Donahoe takes over.
Right. He steps in with the strategy already set in motion, but the pressure's on him for flawless execution to really prove that $24.4 million sacrifice was the right call.
Okay, shifting gears just a bit to the bigger picture. What did management say about the macro environment? Tailwinds, headwinds?
Well, the main tailwind from their perspective is definitely the Texas economy. They noted it's expected to keep growing faster than the overall U.S. rate.
So a favorable operating backdrop compared to maybe some other regions.
Yeah, that gives them a bit of an edge.
So what does this all mean for the big question? Interest rates. What's their outlook?
They see potential for some movement at the next Fed meeting later this year. Nothing too specific there. But looking out to 2026, they're planning for at least 2 rate cuts.
2 cuts in 2026.
At least, with potential for more, depending on, the usual suspects, inflation, jobs. But interestingly, they also mentioned the shift in Fed leadership mid-year.
Oh. Hinting maybe new leadership might be more inclined to cut.
That seemed to be the implication. Maybe more sensitive to external economic pressures. #tag this is not financial advice segment. Trade ideas.
Okay, we've unpacked the story. Short-term pain, reported as that big gap loss for what management promises is long-term gain via higher NII. The market reacted.
Well, skeptically.
Definitely cautious. So given that core tension, the noise now versus the strategic certainty they project, we can actually build a pretty plausible, high-conviction trade idea here. Remember, this is absolutely not financial advice.
Definitely not. But the psychology is interesting. The market right now is clearly valuing the certainty of that $24.4 million loss. It's real, it happened, it hit the books, that's why the stock underperformed. But what the market seems to be heavily discounting is management's promise the NII uplift, that sub-4-year payback. Investors want proof. They want to see the NIM stabilize and improve before they'll reward the strategy.
Okay, so the pitch, the idea is basically a long position. Time to capitalize on that payback once the noise starts to clear. Betting on their execution.
Correct. The catalyst here would be the next couple of earnings reports, Q4 2025, Q1 2026. The trade idea bets that the NIM increased the payoff from the restructuring, and those favorable CD repricings shows up faster and cleaner than the market currently believes.
So the time to potentially think about it is while the noise is loudest, while the market is looking backward at the Q3 gap hit.
That's the thesis, because if that 9-9 stabilization does materialize like they forecast, well, that should force a re-rating relative to peers. It could close that underperformance gap we saw post-earnings.
So it's not a bet on some vague hope for the future. It's a bet on basically financial mechanics delivering a pre-calculated yield uplift.
Exactly. A bet on execution discipline winning out over near-term sentiment. #tag conclusion. So wrapping it up, this quarter's story from Southside Bancshares was unusually clear, wasn't it? They strategically took a big hit, that $24.4 million loss, effectively guaranteeing, or so they believe, a higher NII path forward. And that was coupled with pretty strong core execution on loans and deposits.
Yeah, the message was clear, but the market's reaction was cautious, demanding proof, like you said, before really buying into the strategy. Which leads to the final thought for you, the listener, to maybe mull over as you watch this bank. How much runway does the new CEO, Keith Donahoe, actually have? How long before the market demands to see concrete proof in the NIM figures that this sub-4-year payback is actually on track?
Yeah, if he misses that Q4 guidance, for instance, the pressure could mount very quickly.
Something to watch.
Well, thank you for joining us for this deep dive into SBSI's Q3 results. We appreciate you exploring it with us.